the IRS has issued a new proposed rule. This came on June 10th that allows a tax deduction for money spent for certain healthcare programs and arrangements. For the first time, this would include direct primary care and healthcare sharing ministries. Neither of these are comprehensive insurance. They do not come with consumer protections, and the feds are accepting public comments through August 10th, 2020. This tracks back to Executive Order 13877, called Improving Price and Quality Transparency in American Healthcare to Put Patients First. That was back just over a year ago that executive order was written, and it directed the Department of the Treasury to propose regulations to treat expenses related to certain arrangements as eligible medical expenses. And that's what we have now. This proposed rule is acting on that executive order that said, show me some regulations about how to treat these expenses, and the Treasury responded with this proposed rule. Now, it first of all defines direct primary care in the regulation, and then it defines healthcare sharing ministry. And let's share both of those definitions. The proposed regulations define direct primary care arrangements as a contract between an individual and one or more primary care physicians, where the physician agrees to provide medical care for a fixed amount or a periodic fee without billing a third party. So it cuts the middleman out of the equation. It cuts the insurance out of the equation and instead replaces it with a flat fee for service or an a la carte menu of services. Like we said, the regulation defines healthcare sharing ministry as an organization exempt from taxes, and members share a common set of ethical or religious beliefs. They then share medical expenses among the members in accordance with those beliefs without regard to the state in which the member resides or is employed. This is not insurance, it is not regulated, and individuals selling these do not necessarily have to follow the licensing requirements that their state insurance commissioner might impose on other agents. In fact, 30 states actually have safe harbor rules that exempt plans from state insurance regulation. In the state of Wisconsin, where we are, we have one of those safe harbor rules, which means there's also no legal obligation to pay a member's costs. There are restrictions on what can be covered, especially in the healthcare sharing ministry rules. If there is a service that is deemed not in compliance with the morals of the member of that plan, they do not have to cover that. But they also don't have to cover things like the Affordable Care Act's essential health benefits, like maternity coverage or newborn screening, or even prescriptions. Here's what the rule itself coming out of the IRS actually does. If you itemize your tax deduction, you may include medical expenses as part of those deductions if they are more than 10% of your household income. This rule would include direct primary care and healthcare sharing ministries as allowable medical care expenses for purposes of those tax deductions. So for the first time, it includes direct primary care and healthcare sharing ministry in that broader definition of allowable medical care. It also includes payments to Medicaid, Medicare, TRICARE, and Veterans Health programs as part of those medical expenses that could be included in that deduction, likely, if this makes us all the way through, for tax year 2021. It relies on classifying these healthcare sharing ministry and direct primary care plans as insurance. It's essentially broadening the definition of insurance, even though it's clearly not insurance and not even regulated as such in the states in which it exists. Here's the reality of this rule. These changes will have little to no impact on consumers whatsoever. The threshold to make it worthwhile to itemize these deductions is too high, and the deductions will likely have no bearing on low-income earners at all, especially somebody that's enrolled in Medicaid. They're not going to have enough medical expenses to make it worthwhile to itemize their deductions and then claim the payments made through Medicaid or Medicare as part of it. Unlikely spending on ministries like healthcare sharing ministries alone could push someone above that standard deduction. So why do it? Well, here's what a lot of the health policy pundits are saying. It's essentially just to entice people into these other arrangements, to pull them out of traditional comprehensive Affordable Care Act type insurance plans to instead participate in this plan. If you're trying to make a pros-con list of why you might want to participate in something other than comprehensive health insurance, you might look to something a little cheaper. You might then see the fine print that says, oh, and you can now itemize your costs, and these costs that you pay towards these plan, you could include in that deduction. It might look appealing, even though it might never have an impact on you. you. This Trump administration, has been pushing for alternatives to traditional comprehensive health insurance from the start, for short-term junk plans, as we call them, association health plans, healthcare sharing ministries, direct primary care, all as alternatives to the Affordable Care Act and to comprehensive care. Now, they have gained some popularity because they are seen as cheaper alternatives to comprehensive insurance. But like we said, even though it mimics insurance, it is not insurance. It can discriminate against people with pre-existing conditions. They can cap coverage. They can refuse to pay for any services whatsoever. They can leave people exposed to liabilities, to bills, and to surprises, especially in a time of national pandemic. We don't need alternatives to traditional insurance. We need insurance that will cover the services that people expect them to. And to the traditional argument against some of the short-term limited plans is that they actually do distort the risk pool. They are pulling people out of the comprehensive risk pool, making it a riskier, more expensive place to be, and therefore diminishing the importance of the insurance overall. Like we said, there's a public comment period that is open right now on this proposed rule. It runs through August 10th. We share the details here of how to share your comments if you have thoughts on this IRS rule and these in its proposed state. We give you the information you should include about what number of regulation to include if you do submit public comment. In the description below, we link to the proposed rule. You can read that. We also share more information about healthcare sharing ministries and direct primary care as drafted by other experts in the field.